You went to an in-network hospital. You used an in-network surgeon. You followed every single step your insurance card told you to follow. And then, weeks later, an envelope showed up in your mailbox, and inside was a bill for thousands of dollars. Not because you did anything wrong, not because you missed a payment, but because the anesthesiologist standing next to your surgeon during the procedure happened to be out of network. You never chose that person. You never signed a form agreeing to their rates. They were just there, in the operating room, doing their job, and now that bill is yours. This is not a rare edge case. This is one of the most common ways a health insurance claim gets denied or partially paid in the United States right now, and most people have no idea it can happen until it already has. Here is the number that should stop you cold. According to data from the Kaiser Family Foundation, ACA Marketplace insurers denied approximately 19% of in-network claims in 2024, nearly 1 in 5. And when you factor in out-of-network claims, that number climbs closer to 37%. Overall, roughly 1 out of every 5 claims submitted gets rejected before a single dollar reaches your provider. Now think about what that means for the average American family. You are paying your premium every single month. You are going to the right hospitals. You are seeing doctors who are supposed to be covered. And statistically, 1 in 5 of those visits is going to generate a denial letter rather than a payment confirmation. The question is not whether a denial could happen to you. The question is whether you will know what to do when it does, and whether you took any steps beforehand to make it less likely. That is exactly what this video is going to walk you through. Not scare tactics, not fine print that you need a law degree to decode. Just a clear, step-by-step breakdown of why claims get denied, how the system actually works, and what you can check right now before you ever step inside a medical facility again. Let's start with the most misunderstood word in your entire policy, covered. When most people hear that a procedure is covered, they assume it means paid for. Those two words are not the same thing. Covered means the procedure is eligible to be considered for reimbursement. It does not mean the insurer will pay the full amount. It does not mean the insurer will pay without conditions. And it absolutely does not mean you will owe nothing. Your policy almost certainly contains something called a coverage exclusion list. This is a section, sometimes buried deep in the documentation, that spells out what your plan will never pay for under any circumstances. Common exclusions in many standard plans include elective cosmetic procedures, weight loss surgeries in certain contexts, some mental health treatments, experimental or investigational procedures, and specific medications that your insurer has decided are not medically necessary under their internal guidelines. The phrase, not medically necessary, is doing a lot of heavy lifting in your policy, and you need to understand exactly what it means. Medical necessity is not determined by your doctor alone. Your insurer has its own clinical criteria, and those criteria do not always match what your physician recommends. A doctor can believe a treatment is absolutely essential. The insurance company can disagree, and when they disagree, the claim gets denied. This is not a loophole. It is a feature built directly into how health insurance operates in the United States. So how does the insurer decide what is medically necessary? Most major insurers use clinical guidelines developed by third-party organizations like Milliman or Interqual. These are proprietary sets of standards that determine whether a given diagnosis justifies a given treatment at a given intensity. If your situation does not check the right boxes on their internal scorecard, the answer is no. Regardless of what your doctor says, regardless of how serious your condition feels, and regardless of how long you have been a paying customer. This is the first thing you should look up in your own policy right now, the medical necessity definition section. It will typically appear under a heading like coverage determinations or medical policies. Reading it once before you ever need it will change the way you approach every future appointment. Now let's talk about prior authorization, because this is where a massive number of claims fall apart before they even begin. Prior authorization, sometimes called pre-authorization or pre-cert, is a requirement that your doctor get approval from your insurance company before performing a specific procedure or prescribing a specific medication. If your doctor skips this step, or if the authorization comes back denied, you could be responsible for the entire bill even if you are otherwise fully covered. And here is the part that catches people completely off guard. The list of procedures that require prior authorization has grown significantly over the past decade. It is no longer just major surgeries. In many plans today, prior authorization is required for certain specialist visits, specific imaging like MRIs and CT scans, brand name medications when a generic alternative exists, mental health treatment beyond a certain number of sessions, and in some cases even standard outpatient procedures. According to the American Medical Association, physicians reported spending an average of nearly 14 hours per week in 2023 dealing with prior authorization requirements. That is almost 2 full working days every single week just navigating insurer approval systems. When the administrative burden gets that heavy, delays happen, approvals slip through the cracks, and sometimes a procedure happens before the authorization lands, which means the claim gets denied on a technicality. The safest thing you can do before any non-emergency procedure is call the member services number on the back of your insurance card and ask one direct question. Does this specific procedure code require prior authorization under my plan? Write down the name of the representative who answers. Write down the date and time. If you are ever challenged later, that record is your first line of defense. Let's move to the in-network versus out-of-network problem, because the anesthesiologist story from the beginning of this video is far more common than most people realize. When a hospital is in your network, it means that hospital has a negotiated contract with your insurer. But the individual doctors who work at that hospital may have their own separate contracts, or no contract at all. Your surgeon might be in network. The radiologist who reads your scan might not be. The assistant surgeon brought in mid-procedure might not be. The pathologist who analyzes the tissue sample might not be. You had no input on any of those choices, but in many states, those bills can still land in your lap. The No Surprises Act, which took effect in January 2022, was designed to limit some of this exposure, specifically for emergency situations and for cases where you had no reasonable ability to choose your providers. Under that law, out-of-network providers in qualifying situations are generally limited to charging you the in-network cost-sharing amount, but the law has exceptions. Non-emergency scheduled procedures can still generate out-of-network bills if you signed a waiver, even one buried in a stack of intake paperwork, and the dispute resolution process that backs up the law is still working through a backlog that has made enforcement inconsistent. The practical step before any hospital procedure, scheduled or otherwise, is to ask your hospital's billing office for a list of every provider who will be involved in your care and their network status. You have the right to ask. Most billing offices will give you an answer, and if anyone on that list is out of network, you can either request an in-network alternative or at minimum go into the situation with your eyes open rather than waiting for the bill. There is one more layer to the network problem that most people never think about until they are already dealing with the fallout. Referrals. If you have an HMO plan, a health maintenance organization, you almost certainly need a referral from your primary care physician before seeing a specialist. This is not optional paperwork. It is a coverage gate. If you call a cardiologist directly and schedule an appointment without getting that referral first, your insurer may refuse to cover any part of that visit, even if the cardiologist is fully in network and even if the medical need was completely legitimate. PPO plans are more flexible on this point. You can generally see specialists without a referral, but PPO plans typically carry higher premiums and higher out-of-pocket costs when you do go out of network. The flexibility comes at a price, and the pricing structure matters enormously when you are estimating what a year of medical care might actually cost your household. Understanding your plan type is not optional background knowledge. It determines the rules of your specific coverage game. HMO or PPO, EPO, or HDHP, each one runs by a different set of access rules, cost-sharing structures, and denial triggers. If you do not know which type of plan you currently hold, that is the first thing to find out. It is printed on your insurance card and spelled out in the first few pages of your summary of benefits and coverage document. Now let's talk about what happens after a denial, because this is where most people give up, and that decision costs them money they could have recovered. When you receive a denial letter, you have the legal right to appeal. This is not a courtesy offered by your insurer. It is a right protected by federal law under the Affordable Care Act. Every denial letter is required by law to include the specific reason for the denial and the instructions for how to file an internal appeal. If your plan does not include that information, the denial itself may be procedurally invalid. The internal appeal process asks you to formally request that your insurer reconsider the decision. You are essentially saying, here is additional information, here is a supporting letter from my physician, and here is why your denial was incorrect. According to data compiled from ACA Marketplace plans, the appeal success rate for internal reviews has ranged between 30 and 40% depending on the year and the type of claim. That means a significant portion of people who push back actually get the original decision reversed. But the overwhelming majority of denied claims are never appealed at all. People see the word denied, assume it is final, and start figuring out how to pay the bill. The insurer is counting on that reaction. The math works in their favor when most people walk away. If your internal appeal is denied, the process does not end there. You have the right to request an external review. This means an independent third party, not affiliated with your insurer, reviews the denial and makes a binding determination. If the external reviewer finds in your favor, your insurer must pay the claim. The external review process exists specifically because internal appeals can be influenced by the insurer's own financial interests. Having an outside decision maker in the loop is a meaningful check on that dynamic. The window for filing an appeal matters. For most plans, you have 180 days from the date of the denial letter to file your internal appeal. Missing that deadline can mean losing your right to challenge the decision entirely. So if a denial letter arrives, the first thing to do is note the date and understand your timeline before anything else. Let's shift to prescriptions, because drug claim denials follow a slightly different path and catch people off guard in their own specific ways. Your insurer maintains something called a formulary, essentially a tiered list of approved medications. Tier 1 is usually generic drugs with the lowest cost sharing. Tier 2 is preferred brand name drugs. Tier 3 is non-preferred brands. Tier 4, in many plans, is specialty medications that can carry cost-sharing percentages rather than flat co-pays, meaning you pay a portion of whatever that drug costs at full price. For specialty medications, that percentage can translate into hundreds or even thousands of dollars per month out of pocket. When your doctor prescribes something that sits in a high tier or falls completely off the formulary, the claim either gets denied outright or gets approved only at a cost that makes the medication effectively unaffordable. This is one of the most common points of friction between what doctors want to prescribe and what insurers are willing to pay for. If your medication is denied because it is not on the formulary or because the insurer requires a lower-tier drug be tried first, your doctor can file what is called a step therapy exception or a formulary exception. Step therapy is the insurer's requirement that you try a cheaper medication before they approve the one your doctor originally recommended. The exception process allows your physician to argue that the standard step therapy approach is clinically inappropriate for your specific situation. These exceptions are granted regularly when the supporting documentation is solid. The practical action here is to ask your doctor's office, before you fill any new prescription, whether that drug is on your plan's formulary and what tier it falls into. If the answer is not clear, your insurer's member services line or their website's drug lookup tool can tell you within minutes. Knowing before you pick up the prescription is always better than disputing the cost afterward. Now let's bring all of this together into a concrete pre-visit checklist, a set of questions you can walk through before any significant medical appointment or procedure. First, confirm that your specific provider is in-network, not just the hospital or practice group. Individual providers can have different network status from the facility they work in. A quick call to member services with the provider's National Provider Identifier Number, their NPI, is the most reliable way to verify. Second, ask whether the procedure or service you are receiving requires prior authorization. If it does, confirm with your doctor's office that authorization has been submitted and approved before your appointment date. Get the authorization number in writing. Third, if your procedure involves a facility, ask the billing department for a list of all providers who will be involved. Request the network status of each one. If any are out of network, ask whether an in-network alternative is available or request that they notify those providers to bill at in-network rates. Fourth, check your deductible status. If you have not yet met your annual deductible, every approved claim still costs you money until that threshold is crossed. Knowing where you stand on your deductible affects the actual dollar impact of any visit. Fifth, for any new prescription, check the formulary tier before filling it. If the cost is prohibitive, ask your doctor about a formulary exception or a therapeutic alternative that falls in a lower tier. These 5 questions will not prevent every denial. The system is genuinely complex, and some situations involve gray areas that no checklist can fully anticipate. But the majority of claim denials that stem from procedural issues, missing authorizations, out-of-network unknowns, formulary mismatches, are preventable when you ask the right questions before the service happens rather than trying to unravel the billing afterward. One final point that does not get enough attention: your explanation of benefits, or EOB, is not your bill. When your insurer processes a claim, they send you an EOB that shows what was billed, what they paid, what was adjusted, and what they are saying you owe. Many people receive these documents, see numbers that look alarming, and either panic or ignore them entirely. The EOB is a record of how your insurer processed the claim. The actual bill comes separately from your provider. Before paying anything, compare the EOB to the provider's bill and make sure the numbers align. Billing errors are more common than most people assume. A 2022 study estimated that roughly 80% of medical bills contain at least one error. You are not required to pay for errors. You are allowed to request an itemized bill and dispute any charge that does not match your records. Health insurance in the United States is genuinely complicated. That is not an excuse the industry offers. It is a structural reality that affects millions of households every single year. But complicated does not mean impossible to understand. The people who navigate it best are not the ones with the most expensive plans or the most connections. They are the ones who learned the vocabulary, asked the questions early, and treated their policy as something worth actually reading. You paid for this coverage. Understanding how it works is not optional homework. It is the difference between using your benefits and losing them.